Welcome to Talk Tickers, where we break down the latest earnings calls. Today, we're diving into Commercial Metals Company, or as you probably know them, CMC.
So here's the big question, right? CMC absolutely crushed their Q1 earnings, but then the stock drops 3.6%. What gives? It's a classic Wall Street head-scratcher. So let's dig in and figure out what the market saw that the headline numbers didn't show.
Okay, first up, the beat and the drop. Let's start with the good news, the numbers that on paper looked absolutely fantastic.
And I mean, just look at this. Their adjusted earnings per share hit $1.84. The street was only looking for $1.56. That's a huge beat. Same story with revenue, over $2 billion. Again, beating expectations. You look at this and you think, wow, this is a home run.
But this was the reaction, down 3.6% on the day. So you have this massive beat on one hand and a pretty significant sell-off on the other. It just doesn't add up, right?
And here's the real kicker. The trading volume was insane, up about 241% compared to a normal day. So this wasn't just a few people selling off. No, this was a big, high-conviction move. A ton of shares changed hands, and they were pushing the price down. The question we have to answer is, why? What spooked everyone?
All right, section 2. Let's look under the hood at that stellar Q1 performance. Because if you just look at what they did last quarter, the company's side of the story makes a ton of sense.
I mean, check this out. The North America steel business, their core profit, that's kind of what EBITDA is, it jumped almost 58% from last year. 58%. And then you have their construction solutions group, even better. EBITDA was up almost 75%, and they hit a record 20% margin. I mean, these aren't just good numbers, these are blowout numbers.
And you can bet management was feeling good about it. The CEO, Peter Matt, basically said it was one of the best quarters in the company's entire history. He called it an excellent start and proof that their big strategy is paying off. So if you're inside the company, you're popping the champagne, right? Everything's looking up.
Okay, so if Q1 was so amazing, what went wrong? Well, it all comes down to the future. Let's talk about the guidance because this is where the market got hung up.
And here it is. This is the smoking gun. The market basically tuned out all the good news from Q1 and focused only on this. They said their core profits would decline modestly. The North American steel business would be a little weaker, seasonality, some maintenance, and then the big one, Europe is expected to be just break even. For Wall Street, hearing decline and break even was all it took. That's what triggered the selling.
But here's the thing. While the market was panicking about the next 3 months, management was trying to tell a much bigger story, a long-term story. Let's look at their long game, focusing on Precast and Europe, because this is the stuff the market just seemed to totally ignore.
First up is their big push into precast concrete. So what's that? Well, they've been buying up companies in this space, and they expect those new businesses to add a whopping $165 to $175 million in profit this year alone. It's a really smart move, actually. It gets them into higher margin products and makes them less dependent on the crazy ups and downs of steel prices.
The other big piece of the puzzle is over in Europe. It's this thing called CBAM. Now that sounds complicated, but just think of it like this. It's a new EU tax on imported steel from places that don't have strict pollution rules. So it makes that cheaper, less green steel more expensive. For CMC, who has a big operation in Poland, this is fantastic news. It levels the playing field and should give their European business a really nice boost later in the year.
So let's put it all together. What do we make of this? You've got this battle, right? Amazing past performance versus a kind of murky short-term future. So for our final section, let's talk about what to watch for on the next call and give you our rating.
When that next earnings report comes out, here's what we're going to be laser focused on. 1. Pricing. Are they still getting good prices for their future projects? That's crucial. 2. Precast. Can they actually deliver on that $170 million profit promise from those new companies? And 3. Europe. Is that CBAM policy actually starting to help their bottom line? These 3 things will tell us everything we need to know about whether the bulls or the bears are right about this stock.
So, taking all of that into account, our rating is market perform. Look, the long-term story here is really compelling. We see the potential. But the short-term risks are just too big to ignore right now. They've got to prove they can pull it off.
So what's the takeaway for you? Honestly, we think the stock is probably going to be stuck in a range for a little while. It'll trade sideways until the market sees proof that the new strategy is actually working. If they come out next quarter and smash those precast numbers or show that Europe is really taking off, that could be the catalyst that breaks the stock out to the upside. But until then, it's a wait-and-see game. And of course, remember, this is not financial advice.